Good afternoon, and welcome back to the Capital Group's YouTube channel for our first live webinar of 2022. I'm Eric Mothershead, partner at the Capital Group, and I'll be your host for the next 75 minutes. Super excited to be joined by Matt and Anthony from GSA National, and we're going to be taking your questions live today on our YouTube channel. For over 2 decades, the Capital Group has provided healthcare, commercial insurance, and 401k strategies to the government contracting community. And we're thrilled that you've taken out this afternoon to join us for our SCA webinar. Today, we're going to be tackling one of the stickiest topics in federal contracting, Service Contract Act administration. This landscape is fraught with DOL rules and regulations that are often nuanced and easily misinterpreted. Well, we're going to spend the next hour and 15 minutes breaking down the complex into the simple, and we're going to try to answer your questions along the way. Today, we have 2 special guests with us, Matt Corzine, President of GSA National, and Anthony Zarb, Director of Business Development at GSA. Since 1991, GSA National has been a leader in the SCA administration space, assisting federal contractors with consulting, compliance, and administrative services. The stakes are high, very high, and making sure that your health and welfare spend is in order. If we've seen anything at all, the DOL has taken a no prisoners approach to SCA audits. Throughout today's live webinar, we're going to be taking questions. Please submit them through our live chat feature, and I'll be monitoring with our panel of experts. We're going to cover a lot today, so let's dig in. Matt, please take it away.
All right, great. Thank you, Eric. I appreciate that introduction and welcome everyone to today's webinar. We are going to start just with a quick housekeeping item. If you are a member of SHRM, this webinar does provide 1 credit. You'll see the activity code here on the next slide to get your continuing education credit. But let's talk just for a minute about GSA National. We've worked with the Capital Group for several years around the area of SCA compliance, but some of you may not be familiar with who we are and what we do. GSA National has been around helping government contractors ensure compliance and streamline costs since 1991. We work exclusively in the government contracting space, working with clients ranging from 100 SCA employees up to 16,000 SCA employees. And as a service organization, we are proud to boast a client retention rate of over 97%, and our longest running client is over 20 years. There are 3 pillars, if you will, of what we do here at GSA National. The first is compliance. We provide consulting, compliance, and administrative outsourced services to the industry's leading government contractors. We also do a lot of education, such as today's webinar. We offer Service Contract Act, Davis-Bacon and related acts, compliance, conformance analysis, audit support, and more. And support. We specialize in the design, management, and administration of employee benefit programs for government contractors. Now, as Eric alluded to, there are a number of different areas of SCA compliance to consider, ranging from minimum wages to classification of workers and what are called job conformances, enforcement, which we'll touch on, fringe benefits, which is where we're going to spend the most of our time today. Fringe benefits include 2 primary areas. First is health and welfare, otherwise known as the fringe or the H&W, if you will. And the second is vacation and holiday pay. We're not going to get a lot into that today, but if you're interested in or have questions about that, we can answer those questions as well. SCA also involves some requirements around notices. There is a very specific lunchroom poster, if you will, that must be posted for employees. And also, as Eric alluded to, there's a lot of record keeping that is required of SCA to demonstrate compliance. There is a limited amount of reporting that government contractors have to do around SCA compliance. So there's no annual filing requirement per se around how a contractor meets this requirement, but there's a lot of expectation or a high bar in terms of the amount of record keeping that an employer has to be able to demonstrate compliance in the event of an audit or so on. Now, SCA has several compliance challenges, to put it lightly. And the biggest one, potentially the biggest one, is that compliance requires involvement from multiple business functions across the contract lifecycle. And although systems can help manage compliance, they generally lack standard SCA compliance tools. Thus, manual processes are typically necessary to maintain SCA compliance. One of the interesting things about SCA, and we talked about the lunchroom poster on the earlier slide, but contractors are actually not required to provide and typically cannot provide health and welfare compliance statements to employees illustrating how the employer is meeting its health and welfare obligation. And that creates a situation where employees without that employer provided information on H&W compliance are often confused, misinformed, have incorrect assumptions about how it works. And those employees are more likely to file a complaint with the DOL, Department of Labor, which presents its own set of challenges, which we'll talk about shortly. As a result of all this, contractors may choose to outsource specific aspects of compliance to third-party administrators to achieve internal efficiencies, ensure accuracy, and provide employee H&W statements.
Hey, Matt, a quick question that just came in. Where does SCA compliance responsibility typically land in an organization?
It's a great question. So it depends on what area of SCA compliance we're talking about, right? So if we're talking about job classifications, meaning making sure the employee is classified into the correct position that has a specific wage rate, that's going to fall on, that responsibility will fall generally on the program management, the people running the program, operations. When you talk about the health and welfare compliance, oftentimes, but not always, that falls on the shoulders of the benefits or HR team. And sometimes it will fall on finance as well.
And where do you see contractors struggling the most?
I'm going to let Anthony actually answer that one. He talks to a lot of contractors that come to us, right, because they have experienced a challenge of some sort and a struggle. So Anthony, I'm going to let you take this one.
Sure. Thanks, Matt. I appreciate it. Thanks for the question, everybody. Well, simply said, there are several reasons why contractors would seek a third-party administrator like GSA National. One of the first things that comes to mind is obviously compliance. GSA National provides 100% compliance on the health and welfare obligation, meaning that we take all the information you send to us and all the information related to the health and welfare obligation and ensure that based on your contracts and your wage determinations and potentially a collective bargaining agreements, we're providing that reporting back to you that you're fully meeting the expectation or fully discharging your obligation for the health and welfare. Additionally, some other reasons would be cost containment. You know, typically with companies, depending on the size, you can have anywhere from a department of 1 to a department of 6 or 7 people having to manage and maintain this particular process. This could become very cost ineffective for an organization and obviously not something that's really planned to be part of the profitability of a contract. Additionally, ease of administration. Many times, like I had earlier said, that there are multiple people in multiple departments working to ensure the compliance. So this really becomes an overhead burden for organizations. And last but not least, GSA National will definitely help you in regards to a Department of Labor audit. Should you be audited by the Department of Labor, GSA National will help you, stand side by side with you with our reporting, speak to the auditors, work with the auditors, whatever you as an organization or client needs. Just know that GSA National has worked through many of these audits and can be prepared to help at any step.
Thanks, Anthony.
And one other thing to piggyback on Anthony's comments is we see contractors struggling in a couple big areas. One would be depending on where they are in their kind of growth cycle as a company, right? SCA compliance can be relatively simple. If you are starting in the government contracting, maybe you've won your first SCA covered contract that has 5 employees, 10 employees, something like that. And in those situations, a manual process can work fine. But as companies grow, right, and grow to have multiple contracts, employees working on different contracts with different fringe rates, different rules depending on the contract, that obviously gets a lot more complicated. And that's where we sometimes see contractors struggle, is kind of making that shift from having a manual process that worked when they were smaller to now taking that same manual process and having it scale when they're going to 5, 10, 20 different SCA contracts.
Matt, where have you seen penalties come down the pike for these contractors on SCA contracts?
Yeah, that's a great question. So in a couple areas, if you think about it from an employee's perspective, right, the 2 things that are going to affect employees the most are, number one, their wages, right? So if an employee feels that they have been classified into the wrong position, right? So keep in mind each of these positions. So for example, an accounting clerk, there are 3 levels: accounting clerk 1, 2, and 3, that have 3 different pay rates, different levels of responsibility and skill. If an employee feels that they've been doing accounting clerk 2 work, but they've been classified as an accounting clerk 1 and being paid as an accounting clerk 1, you can understand why they might file a complaint. If the DOL agrees with that employee, they certainly, at a minimum, would ask the employer to make the employee whole. And depending on how egregious, if you will, or willful the violation was, could assess penalties from there. The other big issue we see is, and we'll talk more about this a little bit later in terms of the relationship between primes and subs, prime contractors and subcontractors, is the sub, how should I put this? Sometimes taking the prime's word for it around a lot of how the contract needs to run. So is it an SCA covered contract? What is the health and welfare rate, et cetera? And really, we understand that relationship is very delicate, right, between a prime and the sub. But at the same time, what we like to say is that if a contract, let me say it differently, if you are a subcontractor, you really, to save yourself some downstream headaches, want to ask the questions about how a contract should run. Make sure you get that in writing from your prime, so that you're ensuring your compliance, because you are responsible for that.
That's great feedback, Matt. Thank you.
So let's talk, we keep talking about SCA. For those of you that are not familiar with it, SCA refers to the Service Contract Act. It is also known as Service Contract Labor Standards, SCLS. So if you hear SCA or SCLS, they are interchangeable. The DOL typically refers to it as SCA, and so we use that term, but SCLS is correct as well. SCA generally provides that non-exempt or employees working on service contracts and subcontracts be paid and receive benefits according to the applicable wage determination, or WD. SCA applies to services performed in the United States, including U.S. territories. It does not apply to work performed in foreign countries. So that's a really kind of clear dividing line, if you will. And Eric, as you touched on earlier in terms of penalties, there are some real penalties, right? The basic, the easiest you could get off, if you will, is just making the employee whole in terms of a wage rate or health and welfare or so on. But there are increasing penalties that the DOL can assess to a contractor, starting with back payments, civil penalties, going all the way up to suspension or debarment and false claims liability. And obviously, the point, and really important point we want to make here, is that subcontractor violations are the monetary responsibility of the prime contractor. And this is a big deal. And we've certainly seen this in terms of contractors that we talk to, where a prime, it's interesting, Anthony and I were at the National 8A conference last week. So that conference is a great, it's got great energy, because there's all these smaller businesses trying to partner with larger contractors, right? And they even have a kind of a speed dating format to pair groups up together. And one of the things we always like to emphasize is if you are a prime, right? If you're a larger prime contractor looking to subcontract or work with smaller organizations, of course you want to make sure that that potential subcontractor partner can perform the work on the contract, that they can fill the positions and so on. But what we often see missed or maybe not thought about until later is how that subcontractor is going to handle health and welfare compliance, particularly if it's their first SCA contract. And it's just, the general rule here is, as all things compliance related, is it is so much easier to kind of stay in front of these things versus having to unwind something that was done incorrectly, particularly if you're having to do that in the context of a DOL investigation. So we just want to emphasize, if you're a prime, know that you are on the hook for your contractor's compliance. And if you're a sub and you've got your program and your act together, if you will, around health and welfare compliance, I would say promote that as one of your value adds for being a potential partner. The next thing we want to touch on, we're going to go deeper into the weeds here of SCA, is job classifications, wage rates, and health and welfare rates. And we won't spend a lot of time on this, but I think it's an important part of SCA because it gets to compliance and penalties and so on. I mentioned earlier that the wage determination, or the WD as it's known, is a critical part of it. If you know nothing else about SCA, please remember that the WD is your Bible, if you will, of the rules that you have to follow. It includes, first and foremost, the job classifications and wage rates. It will show you the locality to which the wage rates apply, right? You'll see in this example, it's the Texas County of Hidalgo. And then you will see listed, and this is the longest section of the WD, all of these different job classifications. These are the minimum wage rates for the locality. And now these minimum wage rates are unrelated to the health and welfare rates. So just think about it as think of the wage rates and the health and welfare rates as two independent compliance concerns. The wage rates, as you might imagine, are specific to the cost of living in that area. So for example, an accounting clerk 1 in Nebraska, the wage rate for that will be lower than an accounting clerk 1 for New York City. It's just as a good example. SCA, it requires an enforceable wage rate for every labor classification on a contract, which the second part of this is the new classifications can be added via something called a conformance process with DOL approval. Or to say it the other way around, if you take over a contract as a contract, you're the winning contractor and you take over a contract and for some reason you determine that there's a type of position that's necessary to meet the requirements of the contract and it's not in the WD, you cannot and absolutely should not go make up that job description, make up that position, make up the wage rate, right? It's just an easy gotcha, if you will, by the DOL that you're making that up. But there's a fairly simple process you can go through. It's called the conformance process. There is some paperwork involved, but it's not as bad as it sounds to get that job and the wage rate incorporated into the contract so you can stay compliant there. There's something, if you have to do a deeper dive into, well, what's the difference between an accounting clerk 1, 2, and 3? There is a very lengthy document published by the DOL called the Service Contract Act Directory of Occupations. It provides all the job category codes and the detailed descriptions. The other term to know is when you hear prevailing in the locality, that just means relative to the cost of living, right? We all understand that cost of living varies from location to location. So that's what the wage rates are all about. The other item to keep in mind is that sometimes you have situations where an employee can be working in more than one job classification, right? In those situations, depending on your ability to keep the records, you can either just pay them the higher of the two different wage rates, right? An employee would appreciate that. Or if you want to exact cost it, if you will, you can obviously track how many hours they worked on one classification, how many they worked on the other, and pay them the appropriate amount. Yep. Now, we can't talk about wages without talking about kind of the biggest news, if you will, in SCA, which is the new minimum wage for federal contractors. Now, currently, or previously, if you will, the Executive Order 13658 set an initial minimum wage of $10.95 an hour that has increased to $11.25 per hour effective January 1. However, Executive Order 14026, which was announced in last April, increased that minimum wage to $15 an hour. Now, as with all things SCA, it doesn't happen all at once. It's not an across-the-board phase-in. The way this is going to work, and is starting to work, is that starting on January 30th, so just last week, all agencies must incorporate this new minimum wage into their contract solicitation. And then by March 30th, all agencies must implement the $15 minimum wage into new contracts. New contracts is the operative word there, because that doesn't mean that on March 30th, all contracts are going to get the $15. It means when the contract is re-awarded, goes up for recompete and awarded and deemed a new contract, then and only then is the $15 minimum wage in effect. And there's also some language about if an option year is extended, that it should be incorporated and so on. I will also note that this $15 minimum wage will be indexed every year, so we'll go up. And the DOL did issue some very detailed regulations back in November about how this is going to get implemented. The big takeaway I would just keep in mind here is that although, as I said, you will see this minimum wage effectively phased in as all contracts go up for recompete and get deemed new contracts, the executive order actually goes to great lengths to encourage contracting officers to incorporate the $15 minimum wage as soon as possible or now. So there's nothing, to say differently, there's nothing that prohibits a contracting officer from incorporating that $15 minimum wage in a contract today. They don't have to, but you can understand, right, if you put yourself in the mindset of a government contractor, right, the more you can offer in wages, the better you are going to be at recruitment and retention. So smart government contractors who have good relationships, hopefully with their contracting officers, are in their ear already saying, hey, we'd really love to get this $15 minimum wage incorporated into our contract. It would really help us recruit and retain employees. And we've seen some of that happening for sure.
Hey, Matt, we have a question that came in. What are contractors most worried about with the new pending regulation?
Sure, it's a great question. I'm actually going to also throw this one over to Anthony. Eric, again, he's on the front lines of getting some of these concerns from government contractors. So Anthony, I'll let you take this one.
Sure, thanks, Matt, and thanks, Eric. Yeah, just to piggyback a little bit about what Matt said earlier, we were at the 8A conference last week, and one of the things we heard a lot of feedback from both subs and primes was the topic of wage compression. Because the DOL has not provided guidance yet, as Matt had said, the current environment is that they have to wait until their contract has an option year renewed or picked up. And that's when the first time when these organizations will really be exposed to this new process of wage compression, with everybody now working at a $15 minimum wage. So for example, today, utilizing the Directory of Occupations and maybe looking at let's say food preparation, for example, there are three occupations. There's what we refer to as a cook 1, and a cook 2. So in today's world, prior to Executive Order 14026, a cook may be paid $12 an hour, a cook 1 may be paid $14 an hour, and a cook 2 may be paid either $15 or $16 an hour. When the contract is picked up, now that cook 1 and cook 2 are now going to be required to be paid at the $15 minimum wage. And cook 1, and then cook 2 may or may not have had a wage adjustment. This is something that the DOL will have to address, because this is a true issue for employers, looking to understand how to keep all these positions fully stocked, as well as making sure that people are paid appropriately. So we are, eagerly awaiting the DOL's, next round of regulations as to how they're going to manage through this particular process, because for a lot of contracts today, this is something that really keeps them up at night. So hopefully we'll get some information soon, but to this point, we're still kind of waiting for the DOL to come out with some more information on that.
That's great feedback, Anthony. Thank you.
And I'll add it, and I touched on this earlier, but I think it's worth emphasizing, as we've been getting this question a lot recently, is, again, we're now in this kind of odd time where, effective on January 1, the executive order, the old executive order, and has its wage rate, the minimum wage rate, going up to $11.25. But any new SCA contracts are going to be subject to the $15 minimum wage. And again, we'll say this throughout the presentation today, but until you see those wage rates incorporated into the contract, right, through the wage determination, contractors should not do anything, right? You can certainly have those conversations with your contracting officers, but you have to wait till the new wage rates are incorporated or modified, as it's known, into the contract before you take any action on them. And we're going to talk later about working with contracting officers as well. All right, we are going to continue down the rabbit hole of SCA and talk about one of the more, I'm going to say, interesting aspects of how the DOL chose, or has chosen years ago, to drive SCA compliance rules. And it's actually related to this notion of what you might have heard of as an even numbered contract or wage determination versus an odd numbered contract. So you sometimes hear people say, is that an even contract? Is that an odd contract? So we want to explain what that means, because it drives a lot of SCA compliance specifically for the health and welfare. So if you look up a wage determination, which you can do, sam.gov, by the way, is a great search tool for wage determinations. The first thing you want to look at is the wage determination number. It's an 8-digit number, and the last digit of that number, specifically whether it is an even number or an odd number, will determine the health and welfare compliance method for the contract. And you'll see here on the slide, this is the kind of the breakout of what that determination means, right? So an odd numbered wage determination, we like to call those individual contracts, because compliance is measured at the per employee level, versus an even numbered wage determination. We consider those average contracts, because compliance is measured on a per contract basis. The other big difference is how the actual employer health and welfare obligation is calculated. So under an odd numbered or an individual contract, the health and welfare obligation is based on all paid hours, capped at 40 hours per week, multiplied by the health and welfare rate. But on an even numbered wage determination, it's based on all worked hours, multiplied by the health and welfare rate. So we go back earlier to, as an organization grows and has different SCA contracts, some of them might be even, some of them might be odd. You have to know which one the employee is working on in order to calculate the health and welfare correctly, basically. The other things to note here are collective bargaining agreements or union agreements. So there are many, many instances out there of union or CBA agreements in place on SCA covered contracts. If you have that situation, the number one thing to understand is that whatever is written into the CBA supersedes SCA rules. Now, oftentimes what you will see is a more generous vacation policy, a higher health and welfare rate, and so on. So just know that if you have a CBA, you want to pay attention to how it's written, specific to the health and welfare, because those are the rules you have to follow. And the last but not least, and this is really for a separate discussion, but there's a whole separate universe of what's called Davis-Bacon and Related Acts, or Davis-Bacon Act wage determination. So Davis-Bacon Act relates to construction, building things, building buildings, roads, bridges, etc. That compliance works such that it's per employee, it's based on all paid hours. I'll mention that the health and welfare rate tends to be a lot higher. There also tends to be a lot more union covered contracts, right, in the Davis-Bacon world. So that's really a topic for another day, but just know that if you have one of those, you got to understand what you're doing as well. Let's talk more about the health and welfare rate. When you pull a WD from sam.gov, you will see actually two health and welfare rates listed. One is, it will say, so the current health and welfare rate, it will say $4.60 per hour. And then there'll be a second line that says health and welfare EO 13706. EO 13706 is paid sick leave for government contractors. If your contract is subject to Executive Order 13706, there's two things you have to make sure you do. Number one, you have to make sure you're providing the paid sick leave according to the executive order, right? That's the first thing. The second thing is you have to know what your health and welfare rate is, because it's actually lower for an executive order contract versus a non-executive order 13706 contract. One of the challenges, and I think limitations of the WD right now, is that although it lists both health and welfare rates, the WD will not indicate whether Executive Order 13706 applies. The contractor must know that either from the proposal, bid process, or determining it with their contracting officer. So you're not going to see it in the WD. We wish it was there. What you're going to see is the two different rates, and you have to know which one applies.
Hey, Matt, so Executive Order 13706, the H&W rate, it appears to be increasing at a lower rate. Is that accurate?
It is, yeah. And the slide that was just up was starting to get into the history of the health and welfare rate over the past 10 years, right? So we've only had, Eric, we've only had this new executive order since 2017, but we can start to see a pattern, right, in terms of two things to keep in mind. Number one is that eventually all contracts will be subject to Executive Order 13706. So we'll be back to just worrying about that one health and welfare rate. But for now, we live in this kind of strange in-between place where some are subject to we'll call it the full or the old health and welfare rate, and some are subject to the new one. But the more concerning pattern to us, and Eric, I suspect to you all at the Capital Group, is that the health and welfare rate historically has never caught up with the increasing cost of medical insurance alone, right? That's been a persistent problem under SCA. But what we are seeing, as well as others, is that the increase on the executive order health and welfare rate is increasing at an even smaller rate, at least over the past few years. And that just is going to, in our view, exacerbate the problem that the employers have to provide coverage that is paid for by the health and welfare rate.
Yeah, it's going to be difficult as these healthcare rates increase faster than the H&W rate.
Yeah. And Eric, I would maybe just kind of throw just a quick question back to you. I mean, in terms of government contractors that you speak with, I mean, do you find that most of them are kind of making an active effort to try and fit within the fringe, right? So they're getting this kind of fixed amount of health and welfare to provide something in benefit. I'm curious kind of what you see.
Yeah, I mean, most of our clients are offering multiple plans to their employees. We're offering a minimum value plan that will have some money left over for other benefits. But you're looking at those platinum level plans with lower deductibles. It is getting tough for that single rate to fit within the H&W.
Yeah, absolutely. Well, the other thing to mention, if you are lucky enough to be based in Hawaii or working on a contract in Hawaii, they have their own set of rules around SCA, health and welfare. We won't get into that today. If you have questions, you can reach out to us. Hawaii has something called the Hawaii Prepaid Healthcare Act, which complicate things a little bit in terms of SCA, and there's some different health and welfare rates that apply. Let's talk next about health and welfare rate increases. Here at GSA National, we jokingly say that there's a day in the middle of the summer, it's either late June or in July, when the DOL announces the new health and welfare rate. And it's an exciting day for us because it affects all of our clients. It affects, to Eric's point, how much money they have to pay for benefits. And it's kind of like a little mini holiday for us to see what that number is going to be. But the excitement kind of fades quickly because once that number, that new health and welfare rate is published by the DOL, it is not applied to all contracts on that date, right? That'd be too easy in a way, right? Instead, the WD revisions, which incorporate that new health and welfare rate, are done either at what's called a contract option period, which is typically annual, or if there are no contract option periods, no less than every 2 years. So for example, this past year, the $4.60 health and welfare rate was announced in July, I believe. We certainly have clients today that are still operating on an older, lower health and welfare rate because their contract option period has not come around on the calendar, or they could be in a situation where it's an every 2-year increase. So they've got to wait another, potentially a year and a half before that new health and welfare rate comes into effect and gets incorporated into their contract. So it's just, again, one more thing to keep track of. The other thing we would emphasize here is that the contractor or the employer should only provide the new health and welfare rate after their contracting officer has formally notified them. So even if the contract option date rolls around and passes on the calendar, the contractor should not start applying it. That can create some problems. It will probably come out in the wash, and they will probably be reimbursed for that in terms of an equitable adjustment or a retroactive health and welfare rate increase. But administratively, it's just a hassle. And we're going to talk later about some best practices to kind of save yourself some headaches in that area. Which leads my final point here is that ultimately it is the contracting officer's responsibility to ensure that contractors are notified of those rate increases, right? So if you hear, and a contracting officer is often referred to as the CO. So if you hear CO, that means contracting officer. That is, if you are a contractor, the CO is effectively your client. They are your customer. And so it's an interesting relationship to have to navigate sometimes. So we want to talk next about health and welfare compliance measurement. We promise we're not going to make anyone do math today. We do enough of that here at GSA National, but it's important to kind of understand this concept, because if you're doing compliance analysis in-house, or even if you're partnering with someone to do it, you want to understand the basics of how it works. And it's simple in the sense that we like to think of it as an equation or a scale. On one side of the scale, you have the health and welfare obligation. This is the employer's health and welfare obligation to the employee. And put simply, it is calculated as the hours multiplied by the health and welfare rate. Now, the number we like to use, just to kind of put it in benefit speak, if you will, is if an employee is working full-time hours, it will the health and welfare will run about $700 a month. So to be specific about that, that means that employer, right, has an obligation to provide $700 a month to the employee in H&W, and they can do that in one of two ways, which is the other side of the equation. They can provide what are called bona fide employer-paid benefits, and we'll talk more about examples of that in a second. Or they can provide cash in lieu. They can pay the employee the $700 a month in cash. We don't necessarily recommend that in most cases, but that is an option. It's certainly an employee-friendly one, for sure. Now, the DOL and the regulations have this lovely term called bona fide employer-paid benefits. Unfortunately, one of the challenges is that you can't go to the DOL's website and find and search for a list of approved benefits, right, that count towards the health and welfare. That would be too easy. But because SCA has been around since 1965, there's a long precedent of understanding of what benefits count as bona fide, and this page talks a little bit about them. Some of them are the obvious ones: medical, dental, vision insurance, disability, life insurance, any employer contribution to a retirement plan, an HSA, even educational assistance, right, is allowed. One that is often forgotten about, to be candid, by employers is what we like to call earnings benefits. An earnings benefit is something like bereavement pay or jury duty pay. It is rarely, we've never seen a wage determination or a contract require the employer to provide bereavement pay, jury duty, military leave. But many employers do provide that, right? Definitely bereavement and jury duty. Sometimes the military leave is paid or sometimes it's unpaid. But if an employer is doing that, right, if they are out of the goodness of their hearts providing those paid benefits, they can take credit for them towards their health and welfare obligation. So if you're an employer geared around, saving all the costs, taking credit for everything that you can towards your health and welfare, we would encourage you to think about those little kind of hidden benefits that you're paying out as earnings, because you can't take credit for them.
Matt, that's great feedback on bereavement. Yeah, that's great feedback on bereavement and jury duty. Curious, when a contractor wins some SCA work and maybe it's their first experience with SCA, do you find it difficult for them, when the previous contractor was paying cash in lieu? Do you find it difficult for them to kind of claw back that and offer benefits and retirement? What has your experience been with that?
Absolutely. That's a great question, and it's very relevant to us. We have several clients that over the, we know there's a fairly active merger and acquisition environment out there, right, in the government contracting space. We're fortunate enough to have some the acquirers in those situations, several of them as clients. And so we've helped several of them through this question over the past year. And I can kind of give you the spectrum of what they've done. On one end of the spectrum, they have said, we've acquired you. This is how we do health and welfare. Take it or leave it, just to be blunt, because they have, faith in their approach, faith in their program, they kind of a belief that long term, this is the best way that they want to run how they want to do the health and welfare. And they know they might have some turnover, right? And there might be some short-term disruption. And I don't mean to minimize that at all. Believe me, we understand recruitment and retention can be really challenging on this contract. But we have clients that have kind of taken the long view to say, we're going to kind of weather that storm, bring everyone into the fold, and the storm will pass, right? On the other end of the spectrum, we have had situations where a government contractor acquires another government contractor, to your point, Eric, where they were paying all the health and welfare in cash, right? And generally speaking, employees, for very understandable reasons, love getting the health and welfare in cash, right? It adds to their paycheck. And again, I'll just mention from an employer perspective, it's not the best because there are additional expenses that are incurred when you do that. You're paying payroll taxes, amongst other things, and you're not exactly all those things. And you're not able to use those. You're not able to use those health and welfare dollars as effectively to pay for benefits. But we have certainly had at least one instance in recent memory where the employer basically said, well, we're going to let you kind of keep doing what you're doing. And I will tell you, just kind of early evidence is that they've regretted it, right? Because now they've created this situation in their SCA universe where they're treating one group of employees this way, one group another, and you can imagine, you can see where I'm going.
Administratively,
right?
It's a nightmare.
It's a nightmare, and guess what? The employees that are getting where the health and welfare is going to pay for their benefits, when they find out that their colleagues in some other, department, division, what have you, are getting cash, which they, in their minds, is preferred, it's not great. It's not a great situation to have to navigate. So again, we are biased because we just think using the health and welfare to pay for benefits is a more effective approach. But again, we are sympathetic to the cause that employees love getting that health and welfare in their paycheck. We understand that. But what we see is that the larger contractors, right, who have been successful over the long run in kind of weathering the storms of up and down years in terms of claims experience in a self-insured plan environment, have used that health and welfare to pay for benefits and really moved away from the cash. Again, the cash is out there, but that's just not, if I had to say, kind of talk about the trend, it's people moving away from that.
That's great feedback.
And you touched on something earlier, which is kind of segue into like benefits that are not allowed, right? So The best way to think about benefits that are not allowed to count towards the health and welfare obligation are anything that the employer is required to provide. So, for example, FICA, FUTA, SUTA, those employers have to pay that. You can't count that towards the health and welfare obligation. Workers' comp as well. There are also kind of some more esoteric items like incentive awards, student loan repayment, pet insurance. We had a question the other day about, I think it was relocation assistance or something like that. So we have questions like this all the time, but generally speaking, it really has to be a bona fide plan in order to count towards the health and welfare, and a required earnings benefit. So I'll give you the best example being SCA vacation. Employers are required to provide employees with vacation and holiday pay. They cannot count that towards their health and welfare because they have to do it. So we've kind of been dancing around this, but I think now is a good time to touch on the fringe benefit compliance methods, right? So we've talked about the $700 a month on average that employers have to provide in health and welfare. There are 4 main ways that they can do that. I want to touch on each one briefly. The first we've talked about a lot is paying cash in lieu of benefits. Again, nothing wrong with this. It's more expensive to the employer. Employees love it. It can be a good fit, I would say, when you have a part-time population that is not benefits eligible, right? That's where we see some employers leverage that option well. But generally speaking, if you are a larger company, particularly subject to ACA in terms of minimum value and affordability standards, it's not the best option. The second option is to make retirement plan contributions. This is a little bit better because at least there's a tax advantage to that. You as an employer are not being taxed on the amount of the contributions into the retirement plan. But again, it's not helping you pay for benefits. So we rarely see employers doing only option number 2. We often see it as a complement to some other things. The third option is where the employer directly pays for qualified benefits and then performs quarterly compliance reconciliations to identify and true up underfunded employees. Now, that's a mouthful, so let me unpack that a little bit. We talk using my $700 a month as an obligation example. If an employee elects medical coverage, particularly if they elect to cover a spouse or children or family, et cetera, they can very easily spend that $700 and more, right? And the employer has met its obligation in some way. The challenge that employers run into is that if they allow their employees to opt out of the medical coverage, it is nearly impossible to provide $700 a month in benefits, even if you combine everything else together, right? Just disability and life insurance just doesn't cost that much. And so you are almost always going to have employees that fall short of that $700 in terms of the amount that the benefits provided. And the catch is, number one, if you're an employer, you want to know exactly what that amount is. That's the amount you need to, quote unquote, true them up, right? The second thing is that amount is going to vary. It will vary from quarter to quarter because the number of hours that employees work is not set in stone. It varies from week to week, month to month, definitely quarter to quarter. So the math, you have to redo that calculation each quarter because the true up amount can change. The benefits might stay the same, but the hours are going to be slightly different. And the last thing I'll say on this is that if you're choosing this method, which is perfectly acceptable and a great model, you just have to make sure you're doing this true up calculation at least once a quarter. You can do it more frequently. You can do it every paycheck if you wanted, but our recommendation would be do it once a quarter. That's going to kind of allow you to smooth out, if you will, the ups and downs in terms of the hours the employees are working and so on. And then last but not least is the trust model. So the last option is to establish what's called an employee benefit trust, whereby the employer contributes its health and welfare obligation irrevocably into that trust. What that means is, now I should mention this trust and the rules around it, and specifically how it provides benefits to the employees, is still controlled by the employer, right? And it can have the trust can have an institutional trustee. It can have individual trustees that are executives of the company. But the idea is that the health and welfare obligation is contributed into that trust. It's an irrevocable contribution, meaning it cannot revert back to the employer. And that's where you get very nice, we call clean compliance, right? Because the money, the employer, Anthony said earlier, has discharged its obligation at that point. And then the employer can do some interesting things. And we think, and we have experience with clients that have leveraged this model that are only available to them in a trust model. We talked about the irrevocable contributions. We want to emphasize that this trust model works with both situations where you have all fully insured plans, or you may have a mix of self-insured and fully insured plans. So either one works. But there's a lot of flexibility. So the trust model enables an employer to provide this core benefits package that is paid for by the health and welfare, meaning, Eric, once say the capital group goes through your process of the renewal and what the rates are going to be, deciding, okay, SCA employees, if they're going to have the $700 a month that we have to provide in benefits, what's going to fit, right? Typically it's going to be an employee-only medical, a basic life and AD&D, maybe a disability in their insurance in there, and anything that the employee elects above that, they then pay for via payroll deductions or employee contributions. So you can model that out in a way, again, that is most cost-effective to the employer. You can also get sophisticated with this, and we do this for clients where if the client has different contracts running at different health and welfare rates, we will do different cost models based on the contract, right? So a contract that's running at a 460 health and welfare rate has more money to spend, right, than a contract that's running at a 423. And we certainly have situations where the employer is charging those employees in those different contracts slightly different cost shares to try and really get as close as they can to exact costing it. Third thing I'll mention here, which is from a GSA perspective, we are agnostic when it comes to carriers, plans, plan designs, et cetera. We have an interest in the overall health of the trust and compliance, but we are not promoting a particular product or carrier or so on. Eric, trust you all to make those recommendations and so on. Our job is to make sure it fits within the Fringe and we can administer it.
Yeah, the DOL really likes the trust, the fourth option there, especially with self-funded healthcare plans. That makes them very comfortable. So glad you guys are doing that.
Yeah, we've talked before about you can have a self-funded plan without a trust model, right? But it's complicated in that you as an employer must go and obtain DOL approval for that self-funded plan, because what the DOL wants to see is that, again, you as an employer are meeting your obligation in that model. Now, if it's set up correctly, it's very doable, right? But we will say we actually had an inquiry recently about this, about getting this DOL approval, and our best recommendation is you need to go find a strong ERISA/SCA attorney to help you with this. We can speak to it at a high level. Here's kind of the steps, but you really need some legal guidance to navigate that process. It's just complicated enough. You wouldn't want to do it yourself. I'll put it that way.
But it's a lengthy process too. It takes a while to actually get it done. So in our experience, going through the trust model, super easy to do.
Yeah, I mean, I was going to say we're biased, but it's not exactly true. I mean, we understand the reasons that employers may or may not want the trust model. That one just example is that there's some kind of economies of scale that you need with the trust. So you really, to have an individual employer trust, you really want to be at 200 SCA employees or more. Although you can have non-SCA employees in the trust as well, and we certainly have clients that do that. But you really want to have a little bit of scale there. You wouldn't want to stand up a trust for 10 SCA employees. It's just, you'll go crazy right. Just doing the paperwork to get that all done. But yeah, but I would just say, if you look at our larger government contractors that we work with and have continued to grow and be successful over the years, they have all shifted, either started with the trust model or moved to the trust model over the past 5 to 10 years as a way to to be competitive. And that's where this last set of bullets comes into play. So it's all about cost savings, right? Well, let me be clear. If you're a government contractor, it's about cost savings, right? And being as profitable as you can be on the contract, but you have to be able to recruit and retain employees to do that. So it's an interesting balance between cost savings and recruitment and retention. But from a cost savings perspective, one key advantage that the trust model gives you is that when you have a trust, you can require the employees to have what we call these premium reserve accounts, or we call them PRAs, with rules that the employer determines. And that PRA effectively allows the employer to keep the employee covered on benefit when they don't work their expected hours, right? So we like to say that all the great cost modeling in the world, how many hours are they going to work? What's the health and welfare rate? That all goes out the window the first month that the employee goes out on leave of absence, right? Because when they go out on leave, they're not working, obviously. They're not generating health and welfare. But generally speaking, the employer wants to keep them covered on benefit for some period of time. But the employer wants it both ways. They don't want to come out of pocket for that. And so the trust model provides this kind of unique middle ground where you can require the employee to basically reserve a certain amount of their health and welfare. We recommend 3 months, but that's determined by the employer, so that if the employee goes out on leave, there's money sitting in their premium reserve account to cover the benefit premiums when the employee fails to work their expected hours. And the other thing to note here is that if the employee leaves the company and terminates, whatever's left in that PRA ultimately will go to the employee, typically to their retirement plan. The other cost saving advantage, very specific to GSA and what we do, is that third-party expenses to administer benefit plans are allowable. You can count them towards your health and welfare obligation in the trust model, which you can't do. You can't do in other situations.
So it can be cost neutral for the employer.
It can, yeah, it can, and it's interesting. I mean, certainly. There are situations that employees push back on and say, "Oh, I don't think you should be able to charge administrative fees towards the health and welfare." But if you think about, a 401k plan or so on, we actually take let me say it differently. Our philosophy towards this is really promoting transparency. So I haven't talked about this today, but one of our big, soapboxes, if you will, is providing statements to the employees, right? Providing health and welfare or PRA statements, showing them exactly how the health and welfare works. Because, when an employee doesn't have that information, again, as I said earlier, they can be confused or what have you, call the Department of Labor, which triggers really an unnecessary investigation when the employer might have been completely compliant the entire time, but they just didn't have the mechanism to show how they were doing the health and welfare. And so the employee is confused, I guess, to put it nicely.
Yeah, we agree. Yeah, showing the monthly statement, the hours worked, the amount of money earned, that's the cleanest way. And it really puts everyone's minds at ease.
Yeah. And the only thing I'll add to this is that we recommend, showing that administrative fee on the statement. So there's nothing, the regulations back it up. And we certainly can point to those regs, and we'd rather be transparent about it and defend that when we have to. Most employees are very understanding when you say, look, it's allowed by the regulations and so on. And we just believe that all that should be transparent to the employee.
I'm curious from Anthony or from Matt, these premium reserve accounts, you get a company with 300-400 employees, just administering folks that are not working enough hours to pay for benefits at that volume must be an administrative nightmare. And then, I know from experience, some contractors are just, paying the premiums when the employees can't come up with enough money. It's just eating into the profitability of the contract. Interested to hear some feedback from you guys on that.
Yeah, Anthony, you want to take a stab at that, or I can?
Why don't you start and I'll kind of fill in, because
Sure.
you do that every day.
Well, I'll comment on one of the things that often happens when we start working with a government contractor and setting up this trust and setting up the PRA is, to your point, Eric, what was typically happening before is the employer was keeping the employee, keeping an LOA employee, a leave of absence employee, on benefit when they aren't working their hours and just eating that cost, to be blunt. But it's really, that cost is really just buried, if you will, on the carrier bill, right? There's no, rarely is there anyone in the and I mean this as no offense, but like we've just not seen where there's good accounting for, here's how much we are spending to pay for benefits for employees that are on leave of absence, right? Sure. It's just kind of a hidden number. But when we move them to this trust model, or even when we move them to just kind of a reporting only model where we do that quarterly calculation for them, it instantly exposes that expense, right? And it's funny, some of the hardest conversations we have with clients are after the first 2 or 3 months working with them, they see these employees that have just overspent their premium reserve account significantly. And they're like, oh my gosh, GSA, what's going on? Why is this happening? And it's very clear. It's really, you've now had this great little trail to say, well, let's look at it. Here's the benefit costs that we're paying out of the PRA every month. Here's the fact that no money is coming into the PRA. And if you think about the PRA just as a bank account, that's going to happen, right? So it for once, it kind of exposes that. Now the challenge, to be blunt, and we don't take this lightly, to a government contractor as well, now you kind of exposed an area for improvement. How do you go deal with it? And that's hard, right? Because leave of absence is, you oftentimes don't know how long it's going to be. It can be intermittent, which is even a bigger challenge, and so on. So by no means do we pretend that administering leave of absence is an easy task, but at least now when you got either a trust model or some reporting around it, you know how big of a problem, if you will, or expense you got, and then that can allow you to prioritize, like, oh my gosh, we're spending tens of thousands of dollars of whatever month, quarter on this. We need to put some more attention on it. Whereas before it's just kind of buried in the overall benefit expenses. We're coming up near the time, and I want to make sure we get an important part of the training or webinar today, which is contracting officers. We just to shift gears for a second. We've talked before about it from a government contractor's perspective. The contracting officer, otherwise known as the CO, is your customer, right? Is your client, and it's a delicate relationship to navigate, as with any client relationship. But we think there are some ways to do that professionally and effectively to prevent a lot of downstream challenges and headaches for SCA compliance. So we're going to walk through a few of those and just recommendations that we have from working with clients. First and foremost, ask during the bid phase about SCA coverage. Either if you're a sub, you should be asking your prime. I mentioned that earlier, right? Is asking your prime, is this an SCA covered contract? Or ask the government if you're bidding on it directly. If the contract looks like it should be SCA, but the SCA clause or WD are missing, you should not take a hear no evil, see no evil approach to it, right? We've seen that before, like, oh, I guess they forgot to put the SCA clause in, or, one less thing to worry about. And what happens is 99% of the time, that's just an oversight by the contracting officer. And eventually someone complains. DOL comes in and says, hey, contractor, and hey, contracting officer, this contract should have been SCA covered for the past 2 years. So if you just unwind that a little bit, the task of going back and calculating the wage rates, right? You got to go back into all that data. Were we paying them enough in wages? Were we meeting the health and welfare obligation for a 2-year look back, 3-year look back? It's hugely daunting. And we've certainly worked with clients that have come to us in that situation saying, it's interesting. Most of them have been situations where they're the sub and they took the prime's word for it, that it was not SCA. And now they're coming to us saying, hey, GSA, we need help with a 3-year look back analysis because this should have been an SCA contract all along. So if it walks and talks like SCA, it's probably SCA, and you should be asking that question. If you still get the same answer, or you get just kind of no response, you should absolutely document that you at least attempted to ask those questions, right? Don't just rely on verbal conversations or so on. You want to have that to fall back on if there's ever a question.
Hey, Matt, Anthony, why are contractors sometimes hesitant to push their contracting officer and prime contractor ask these questions?
I have two theories for it that we've heard. One is I think sometimes I think contractors think they kind of got lucky on a contract, that the SCA clauses were not inserted, and their life, admittedly, their life would be easier in some ways if it is not an SCA contract. So they're kind of secretly happy they have one less thing to worry about. But I think the bigger, more kind of persistent challenge is it's just the nature of that relationship with the CO. They just don't want to disrupt it, right? They are, and if you are a government contractor, you are, from the day that you take over a contract, you are thinking about the recompete, even if it's 3 years down the road, 5 years down the road. So you are constantly thinking about, how do I work collaboratively with the CO and thinking ahead to how am I going to win the recompete, hopefully down the road.
And Matt and Eric, I mean, one of the other things that we see is, there's a lot of challenges that organizations have in keeping this contract information clear and concise within the organization, because many of the departments all have different needs with the data. So think about a larger organization. You may have folks from the payroll, HR, benefits administration side who are kind of managing the data. You've got the finance team who is really looking at the dollars and cents. And then you've got the business development, the pricing team, who's really looking at it from a perspective of how are we going to make the most money on this particular contract. And quite ironically, of all the platforms out there today that government contractors use, there's not a single platform today that completely manages the process for them. So what typically happens is that somebody's managing a spreadsheet somewhere, and then we find a lot of times that the pricing team or the business development team may not be reaching out to the benefits team at the appropriate time to find out what are our true costs. In this particular situation, they could be misrepresenting themselves when they're pricing out a contract. So this is where we have seen a ton of disconnects, and why a lot of contractors may misprice a contract and they may not win the bid, or the contract may not be as profitable as they thought it would be. So one of the things that we offer, as Matt has said throughout the entire presentation, is the compliance and the transparency. By having a third-party administrator like GSA National working with all of those teams, it kind of brings everybody together. So from the pricing and contracting perspective, these folks are a lot more aware of what the true costs are of the contract, and then alleviating that administrative burden from the payroll, HR, and benefits team, allowing them to really focus on, more meaningful tasks within the organization. And then the transparency and the finances from the finance team. I think, many times we hear from CFOs and CEOs that when we provide them the level of detail of reporting on the financial side, they can see the dollars coming in and the dollars going out down to the penny. And any CFO wants to know exactly where every penny and every dollar is being spent within an organization. So, that's really where the disconnect occurs. But there are ways to manage that process. And again, GSA National is here to kind of help them navigate that and kind of bring all those teams together, providing, best practices for the entire process. And contract inventory is one of the most crucial and foundation pieces that really needs to be maintained and updated. As Matt had said, it's almost like the Bible of the contract itself.
Thanks, Anthony. Thanks for the expertise on working with a contracting officer. It sounds super important to have a good relationship with them.
Thank you.
So the last slide we have is just talking about how you stay on top of contract modifications. We talked earlier about how health and welfare rate increases get incorporated and how the CO has to do that. Best practice here, in our view, is to be proactive about it. Reach out a couple months ahead of time before the anniversary date, put it on the CO's radar, follow up frequently, follow up more assertively, but politely, of course, if the date passes, and always document your communications, even if it's a phone call, send yourself an email, make a note that you had spoken with the CO on that day. And the last thing we'll say here is that sometimes, despite all your best efforts, if you do all the proactive things, you can have a past due contract modification. Let me lead by saying it's not the end of the world, so you don't have to panic in those situations, but there is risk, right? There's risk to the contractor, because if the DOL happens to come in and do an investigation during that kind of past due period, they will most likely come in and say, hey, contracting officer, you need to incorporate the new WD with the new health and welfare rate retroactive to this date. So eventually, the employees are made whole, the health and welfare rate is applied retroactively, and that's fine. But the contractor will typically still receive what's called a non-willful violation on their record. Most people in the government contracting space understand that non-willful means kind of a no fault, if you will. But our viewpoint would be, if you can avoid having any type of violation on your record, even a non-willful one, you can. And it doesn't, I think just doing a little bit of proactive work with your CO on the front end. Again, I know it's easier said than done. It's a delicate relationship, but a little bit of proactive reaching out goes a long way.
Matt, Anthony, thank you for a wonderful presentation today. SCA is a very complex thing to follow, and having a partner like GSA National has made many of our clients feel at ease. So wonderful presentation. To our attendees today, we really appreciate you joining our presentation. We're going to be doing many more of these throughout the year, and we want to thank you for your attendance today. We will have today's presentation on our YouTube channel, so please feel free to reference it down the road if you have an SCA question, or if you have a new colleague that is new to SCA, please feel free to reference our YouTube channel at the Capital Group.
All right, thank you, Eric.
Thank you. Thanks, Eric. Thanks, Matt.
Nice work, everybody.